So one of the questions we're getting asked quite a lot from our investors and just our friendly relationships is, what do we expect to see in the property market after the impact of this coronavirus? And it's a great question. And we like to start at a macro level and then work our way down into the detail, because there's no point getting obsessed with the detail and the minutiae if you're getting lost with the tide. So I think the first thing to note is that we're quite comfortable. We feel very comfortable in the commercial property landscape and the Australian property landscape. And part of that comfort is a glance that we've taken backwards on the last 4 real blips on the radar. So in 1982, there was a short recession, Australian recession, and the national property market rose that year. In 1990, we had the same thing happen. We had a more sustained recession, but also in that year, the national property market rose. In 2001, we had the September 11 and dot-com crash, and that was a sustained recession in the Australian market. Share markets plummeted 40%, and yet the national property market rose in that year. And then, look, most recently, the GFC came and landed, and that was a huge impact. And again, even during that crisis and that recession, the Australian national property market rose. So there's a real robustness to this Australian property market. Now, that's not to say we're not going to see an impact, but at a macro level, it's comforting to know that the Australian property market has a resilience to bumps along the way, along the road. So look, we're probably more concerned with the commercial property market than the residential property market, being a commercial property syndicator. So the big thing for us to note is, how do values get impacted by the coronavirus? Now, values are driven by a number of things, one of them being cash flow, as in a valuer will actually look at the cash flows of an asset, which is the rental income, and create a present value based on the cash flows. So there's an impact there, and then the other impact is actually at a demand and supply level. So it's looking at the market and the impact that the actual sentiment out there, the market out there, is impacting the demand for assets, for commercial assets. So it's important to take a glance into both of those, and the best way to do it is really to understand, and all the discussions we've had with valuers and quite big players in the property market, is that there's going to be a divergence in that prime assets in prime locations will probably hold their own very well. Now that tends to happen in any really uncertainty, where investors start to flock towards stability, security. They start to flock towards things that are tried and tested. Now, the other part of that coin is obviously the secondary market may have an impact, where if you see assets that are suboptimal in suboptimal locations and they're not quite on the strip, or they're a little bit in regional areas, you might see a greater impact to lettability, you might see a greater impact to tenant occupancy, you might see a greater impact to cash flows at those locations. So it's really comforting that when we take a bit of a snapshot across our portfolio, we have a really fantastic core and prime asset base. We've got 75% of our income backed by the right type of tenants, your ASX listed retailers, government tenants, national parties. So that gives us a lot of comfort. The second thing to note is that I think there's going to be a real disparity in different industries, and in property, it's a real big word, is your sector, your industry. So there's retail, there's industrial, and there's office, and those are largely 3 very broad levels to determine different property types. Now, I don't need to be a wizard to let you know that the retail space is going to be affected, because retail really relies on consumer foot traffic and household spending. It relies on mums and dads and households going out and acquiring goods. So that is already being impacted, and I think that's going to be a continual impact in that space that's probably be a bit more sustained. That retail landscape is already experiencing some headwinds from the online retail movement, and I think this is another blow to the retail landscape. So definitely there is an impact being felt, and I think will continue to be felt. So what does that mean? It means that if you're valuing an asset today, and that asset is underpinned by retailers, so underpinned by large format retailers or Westfield, or your supermarket, shopping centres, that as a valuer you may assume there's going to be a larger vacancy. You may assume that there's going to be maybe a lower rent to be derived. You may assume that there's going to be maybe more incentive needed to offer the market to fill a vacancy, and all these things impact your valuation. If we look at the industrial landscape, for instance, across our portfolio, our industrial portfolio has been enormously robust to the coronavirus. We haven't experienced a cent of rent reduction. So in that landscape, fantastic. And then I suppose you need to look at, well, why is that? And I think it's because industrially, you're probably one removed from the households, and you're kind of a little bit further down the chain of production or manufacturing. And the occupiers of that space, in our case, are really fantastic businesses that are servicing the mining, oil and gas sector, are servicing logistics and transport and retail, but they aren't retailers themselves, they're supporting that landscape. So industrially, I think we'll probably find a better outcome than you would experience for retail assets. And then the third one to think about is offices, and that's probably one where there's a real question mark. There's no doubt that businesses have really reacted to the coronavirus in going online and really embracing an or remote working landscape where they can work from home. Telstra's got, I don't know how many thousands of staff working all around the country from their homes. So when we come back to the new world after this coronavirus, and I think it will be a new world, there will be question marks on whether 1,000 square metres is still needed. Maybe that becomes 750 square metres. Maybe 20,000 square metre offices become 15,000 square metre offices, because there may not be that continuing demand for everyone to be in the same place at the same time. I think that's a really fantastic change. I think that's a really fantastic way for the property market to embrace the needs of their tenants. You might find office users really employing a hot desking scenario where you see some of the team are there all the time, but not all of the team are in the office all of the time. So I think there'll definitely be embracing of that culture where employers are more trusting of their employees and allowing them to work remotely, while still maintaining productivity and effectiveness. And I think that will impact the office landscape. But it is an uncertainty. It's a real question mark for us, and yet to be quantified, yet to be really quantified in the property industry.